Welcome to Module 5, Advanced and Institutional Concepts. Today we are moving beyond basic Greeks to understand how institutional players view the market. We will cover the live option chain, put-call ratio, max pain, volatility skew, and expiry day strategies. For the best trading experience, including the advanced live data we will use today, I recommend using the Dhan app. You can use the referral code EJZZI96380 to get started. Let's begin by looking at a live Nifty option chain. In the center, we have the strike price. This is our anchor. To the left, we have call options, and to the right, we have put options. The most important column for institutional analysis is OI, or open interest. Notice the buildup at certain strikes. In this live snapshot, look at the strike 24,500. The call OI is high at 86.70 L. This suggests institutional sellers are treating this as a strong resistance. The IV column shows implied volatility. At the money strike of 24,175, the IV is 9.57. High IV usually means expensive premiums, while low IV, like we see here, suggests a relatively calm market. Finally, look at the volume. High volume combined with high OI indicates where the big money is currently fighting. By the end of this module, you'll see how these numbers tell a story of where the market is likely to move. One of the most powerful tools for sentiment analysis is the put-call ratio, or PCR. The PCR is a simple fraction. You take the total number of open put contracts and divide it by the total number of open call contracts. By the end of this, you will be able to interpret PCR as a contrarian indicator. You can find this value live on the Dhan app dashboard for any index. In our earlier option chain image, the PCR was 1.32. Generally, a PCR above 1 is considered bullish because there are more puts being written than calls. A PCR below 1 is considered bearish. However, the advanced way to use this is as a contrarian indicator. When PCR reaches extremes, it often signals a reversal. Think about it. If the PCR is extremely high, say 1.7, almost everyone who wanted to sell puts has already done so. There is no one left to push the market higher, and the market becomes overbought. This is often when a correction happens. A major limitation is that PCR alone is not a trade signal. It tells you the mood of the market, but you must combine it with price action and support levels before clicking that trade button. Now, let's discuss a concept that often confuses retail traders but is a favorite for institutional data scientists. Max pain. You will be able to explain why price gravitates toward max pain and identify its limitations. Max pain is the strike price where the total value of option contracts, both calls and puts, held by buyers will be the lowest at expiry. In other words, it is the point where option sellers, usually the big institutions, make the most profit, and option buyers lose the most money. The formula for total pain is the sum of the intrinsic value of all call options plus the sum of the intrinsic value of all put options. To calculate it, you would sum up the losses for buyers at every single strike and find the minimum point. Thankfully, the Dhan app calculates this for you in real time. In our live example, the max pain was at 24,100. Why does price gravitate here? Institutions have the most capital and they write or sell the majority of options. To protect their margins, they often use their capital to keep the index price near this max pain level as expiry approaches. However, do not treat this as a guaranteed target. Max pain is dynamic and changes as new positions are created. For example, if there is a sudden global news event, a short squeeze can occur. Even if max pain is at 24,100, a massive surge in buying can force sellers to cover their positions, causing the price to rocket away from the max pain point. Remember, max pain is a magnet, but sometimes the wind of the market is stronger than the magnet's pull. Next, we need to understand a phenomenon known as volatility skew. You might have noticed that the implied volatility, or IV, isn't the same for every strike price. By the end of this, you will be able to identify volatility skew and understand its role in market fear. In a normal market, out-of-the-money puts often have a higher IV than out-of-the-money calls. This creates a skew in the volatility curve. But why does this happen? It comes down to crash protection. Institutions and large portfolio managers are constantly worried about a sudden market drop. To protect their holdings, they buy deep out-of-the-money puts as insurance. This high demand for puts drives their premiums up, which is reflected as higher implied volatility. When you see the skew becoming very steep, meaning the IV of puts is significantly higher than calls, it tells you that market fear is rising. Traders are willing to pay a massive premium just to stay protected. You can monitor this live on the Dhan app. By comparing the IV of a call and a put that are equally distant from the current price, you can gauge whether the market is more afraid of a crash or more hopeful for a rally. Understanding skew helps you avoid overpaying for insurance and helps you identify when the market is becoming overly paranoid. Let's begin by writing out the equation for the area of a circle. The area is equal to pi times the radius squared. Next, let's show the formula for the circumference. Circumference is 2 times pi times the radius. Now, we'll draw a circle and label its radius. The radius is the distance from the center of the circle to any point on its edge. Now let's highlight the area inside the circle. And next, we'll bold the circumference to emphasize it. That's how the area and the circumference relate to the radius of the circle. Even the best traders find themselves in losing positions. The difference between a professional and an amateur is how they manage that loss. You will learn when to adjust a trade versus when to cut losses. When a trade goes against you, you have 3 main choices: do nothing and wait, close the position for a loss, or adjust the trade to move your break-even points. Adjustment techniques include rolling up or down, or rolling to the next expiry. Rolling means closing your current position and opening a new one at a different strike or a different date. For example, if you sold a put at 24,000 and the market drops to 24,050, you might roll down your call side to collect more premium and offset the loss on the put side. When to adjust versus when to cut. The rule is, adjust if the trend is sideways or slightly against you. Cut if the fundamental thesis has failed. If the market breaks a major support level with high volume, adjustments are often just throwing good money after bad. In those cases, it is better to cut the loss and live to trade another day. Let's look at a case study. Nifty short strangle. Entry: Nifty at 24,100. Sell 24,300 call and 23,900 put. Imagine you entered this trade on Monday for a Thursday expiry. Adjustment: market moves to 24,250 on Tuesday. Your 24,300 call is now under pressure. Instead of panicking, you perform an adjustment. You close your 23,900 put, which has gained value from decay, and roll it up to the 24,100 strike. Result: new break-even is higher and you collected more premium. By rolling up the untested side, you increase your buffer on the side that is being challenged. Exit: Thursday. Expiry: if Nifty closes at 24,280, your original trade might have been a small loss or break-even, but because of the adjustment, you walk away with a profit. The Dhan app makes these adjustments easy with its Manage Position features, allowing you to see your new payoff graph instantly. Use the referral code EJZZI96380 to explore these tools. We have covered a lot today. From live option chains to the dangers of gamma, practice these concepts in a simulator before using real capital. Good luck, and trade responsibly.